So Andrew, let's wind the clock back a bit. How did you get into the real estate space?
Sort of in a roundabout fashion. I started off on the sell side with Credit Suisse, actually having worked at the Australian Stock Exchange before that. So I was reasonably familiar with the stock market, but still early in the piece. And being the new guy, they give you the area that nobody else wants to cover, which is real estate and the REITs. And so from that, I was just in a very fortunate position in terms of the listed property trusts, as they were then known, were just starting to come into their own. There was a property crash and they were in very good standing in terms of to deal with the property crash of the early 1990s. And I just thought that this was an industry that would grow naturally because I could see some inherent advantages with listed real estate in terms of liquidity, quality of the real estate, the management capability. And so from that, I guess I learned an appreciation of something that's part of our everyday life and seeing how it transforms and caters the different needs of the economy and society.
What were the main lessons you picked up along the way, and how did those inform your investment process today?
Well, a couple of things. I think simplicity is key. We all overcomplicate things unnecessarily, and it's trying to bring things back to the core. So for me, the one thing I've learned is to try and, I guess, weed out the distractions to the extent that you can, and keep it as simple as possible, and learn to be a student of history, and also recognise the qualities and attributes of some of the world's best investors, etc., to then basically learn from them. Don't try and recreate the wheel, reinvent the wheel when it's already been done by people much smarter than myself. So for me, it's all about recognising how much you can learn from as I say, some of the industry titans, and see if you can apply that to what you do in your everyday work.
Who are some of those industry titans you mentioned?
Well, that's a good question. I don't think I put any particular emphasis on any one individual. I think it's basically absorbing bits and pieces from a whole range of different people, and over the years, I mean, of course, we've all, Ben Graham and Buffett. Of course, that's a pretty easy stock standard one to go to, but there's been lots of other interesting characters along the way, whether it's the Walter Scotts out of Edinburgh, even Capital International, Fund Smith out of the UK, and here in Australia, look, there's numerous great investors that, as I say, are inspirational, and for me, has helped me enormously in terms of be a better investor.
Of course, the big story at the moment is inflation, the rate hikes that go along with that. Then on the liquidity side, you have central banks tapering their bond purchase programs. Why should people consider real estate in that environment?
Yeah, isn't it funny in terms of what we're all worried about today? And when I think back at my career, 25, 30 years ago, we're always worried about something. And today it's inflation and interest rates. And I agree, this is probably the most significant set of changes that I've seen in a long period of time. Now, again, owing to how long I've been in the industry, I was started out in the industry, in fact, when interest rates were double digit and inflation was high single digit, if not double digit. And real estate was able to provide competitive returns in that environment. Now, ultimately, the critical issue that you've got to look at is supply and demand. If you don't have the fundamentals right, everything else really doesn't matter. And so what we've got today is a very distorted market. It's been 10 years since the GFC, in fact, a little longer than that, and yet we're still living with some of the outcomes of that, and most notably QE, which we're now talking about, obviously hearing about tapering. But more importantly, we've seen 20 plus years of declining interest rates. We've had extraordinary interference by central planners, governments and central banks. So I think it's pretty naive to suggest that this is not going to be a pretty exciting period for investors in the next couple of years as we come out of a pretty extraordinary period, being the COVID experience, and as I say, all the interference associated with that, and the supply chain disruption, and the consequent inflation, etc., etc., etc. So the simple answer is, I don't know what's going to happen. And I've never pretended, or what I've learnt to do over 30 years is don't pretend that you know what's going to happen. What you've got to do is stay focused on what matters most, and within your sphere of knowledge and influence. And so within real estate, for me, again, let me go back, 25, 30 years ago, it was high interest rates, high inflation, and real estate performed under the thematic that it was a hedge against inflation. Of course, when inflation all but disappeared, people changed the narrative from a hedge against inflation to a play on interest rates. So to me, it's just convenient what narrative the industry wants or investors want to put on things. At the end of the day, you've just got to look at supply and demand. You've got to look at balance sheets, and you've got to look at management. And if your supply and demand is in balance, if not in fact in favour of the landlord, and you've got a strong balance sheet, and you've got aligned management, then you should be able to generate some competitive returns with other asset classes, particularly on a risk-adjusted basis, however you want to measure that. But ultimately, if you don't have those key ingredients, we're all wasting our time. So for us, it's all about what is the supply and demand picture? Are you capable of having pricing power? And if so, therefore, can you beat the rate of inflation? And today we're seeing some of those conditions present in a number of the key sectors of the real estate market. So, this is why all of a sudden the industry has started to once again talk about the inflation hedge perspective. But again, I stress, it's meaningless if you don't have the right supply and demand characteristics.
Of course, when people think of inflation, they think of the 80s. Are there any lessons we can transpose from the 80s to today?
Sure. So, when I think again to the 80s and the high inflation, one of the boom areas of the real estate market in those days was office buildings. Because you had the deregulation in financial markets in Australia, you had the big bang in the UK, and that was driving outsized demand by the fire areas of the market in terms of real estate, insurance and finance. And as a consequence, there was extraordinary demand for office space. Rents were growing rapidly, and of course that meant that office was seen to be a hedge against inflation when construction costs were rising. So what we take from that is that we're seeing a similar set of dynamics, maybe not for office necessarily, but in some areas of the real estate market today, in that we do have rising construction costs, and therefore new development requires a higher rent to justify the new build, and therefore if you're an existing landlord, an existing owner, building owner, then you've got that protection. And that's why real estate can be a hedge against inflation, because your replacement costs go up and therefore you require higher rent to justify new development. And so that's the inflation hedge story. So that's the one thing we learnt from the 80s. Now, of course, it's also worth remembering from the 1980s, there was a massive property crash. And the thing that caught people out there was too much supply and too much lax lending. And the lax lending, you had the financial market deregulation, so you saw a lot of newcomers come into the market to lend money. The Australian banking sector thought they had to compete, and so they dropped their standards. And so there was ill-disciplined lending to commercial office buildings, and so we saw a glut of office supply take place. And going back to my earlier comments, this is why you've got to look at the supply and demand fundamentals. If you've got too much supply, guess what happens? Happened in the 1980s, saw an overbuilding of office, and we saw one of the biggest property crashes that we've seen. Now, thankfully today, we're seeing a much more disciplined finance, capital, debt market. And so we're not seeing anywhere near the same degree of overbuilding that we've seen in previous inflationary periods. Now, it's early days, we've got to keep a monitor on that. But the good thing is we've had COVID and the supply disruptions, which means that supply coming on is very difficult. There seems to be a shortage of labour, in skilled labour terms. There seems to be difficulty in getting the building materials. We've all seen rising timber prices, etc. And so that's, again, I think one of the things to look at. We're not seeing extraordinary levels of debt being thrown at the market, limited signs of speculative development. Most of the development we see today is largely pre-leased, and therefore it's a much more risk-aware market. Now, that's not to say that there probably isn't risks lurking somewhere in the shadows, and that's what we try to identify, because it's always there, and to pretend that everything's going to be smooth sailing, I think, is pretty naive. But I will say that the fundamentals are pretty reasonable. Vacancy rates in, again, many areas, not all, many areas of the real estate market aren't excessive. We're seeing a good continuation of demand in many areas, and we're seeing limited supply. And again, on the capital side, we're not seeing any limited evidence of lax lending standards. So that sets up a good period for real estate. Now, let's go back to the interest rate story. We've never said interest rates don't matter. Of course interest rates matter. Interest rates matter to everything, right? To all investments. And to pretend otherwise, again, is foolhardy. So what we think we have to do is to identify those areas which are best placed to be able to withstand the impacts of rising interest rates. So that means a strong balance sheet, and again, it means property fundamentals capable of generating pricing power.
What about the work from home thematic? Has that, does reality match up to the media headlines? Or, as you mentioned, those longer leases, has that kind of, carried us through this period where people are working from home?
Sure. Again, it's early days, and it's going to be interesting, isn't it, from COVID, to see the permanent and temporary changes in behaviour from the COVID experience. Our thinking is that we probably are going to a more flexible work environment, but we know that businesses and teams operate better when they come together. Communication's better, innovation we think is better, and so I think most businesses will come back into the office in one shape or another. But it is going to be interesting because, already office buildings, even before COVID, were only occupied 5 of 7 days a week. So if we now cut back to 3 days a week, so the building sits effectively vacant for 4 days a week. That doesn't seem to us to be very efficient utilisation of space. So it is going to be interesting to see how this does in fact play out. Talk of the 4-day week. There's so much we still don't understand how the future of the office looks. But we do think that it is absolutely vital for collaborative space, for collaboration, for the most effective outcomes for a business. So we think it is still important, but we recognise that it's going to be different. It's going to be interesting, the innovation to see in fit-outs. Open plan was taking hold. Do we see people go back into actually dedicated offices and then having breakout shared space? So look, it's a fascinating dynamic. What we're seeing though at the end of the day is that in many markets, particularly in US and Australia, despite all the optimism or the hope for a return to the office, vacancy rates are very high. So yes, people are leasing, but the reality is vacancy rates in office markets are above 10% in many markets around the world. And that's hard for landlords to have pricing power. Now there is talk about obsolescence. So, B-grade office, C-grade office is not going to be able to attract tenants, and that's going to be where the majority of the vacancy sits. So that's going to be interesting to see what happens to that space. Because the old lesson you learn in real estate, the highest and best use. What we'll see is that office will be repurposed, probably to residential, because residential, as we all know, there's a shortage. And so as a consequence of higher prices, we may well see the office inventory actually contract through the conversion of B and C D-grade office space to residential, for example. So it's going to be an interesting dynamic. It's I think early in the piece, but ultimately for the next couple of years, the biggest problem for office you just can't overcome is the vacancy rate. North of 10% means it's very hard for landlords to have pricing power.
When people think of property, they think of residential, of course, they think of probably offices. What are some examples of some other high quality property assets that your funds invest in?
Yeah, that's one of the great things of having a global purview in terms of not only do you have the traditional core areas of office, retail and logistics, but when we look internationally we see in fact residential for rent is actually a very significant feature on global real estate investment trust markets. We see self-storage as being a pretty important area. We see healthcare, a lot of healthcare, senior housing and life science, lab space, office, as well as some other interesting areas, data centres as examples, and probably some of the other more interesting ones is just also the types of retail. So we've got again a very interesting suite of opportunity.
Property is known as a defensive asset class, but actually historically the returns shape up quite well against equities. Is it a mistake for investors to think of property just purely as a defensive play, especially vis-a-vis equities?
Yeah, look, we like the fact that people dismiss real estate. We don't want people to love it because you then get excessive interest and therefore it leads to bubbles. We prefer to be the sector that people don't fully appreciate. The reality is that people do underestimate the cash flows that real estate's capable of generating and quite often overestimate the cash flow that, for example, some technology businesses are capable of delivering. For us, it's all about location. You know the old adage, location, location, location. At the end of the day, that great site, that great property will adapt to the changing needs of the economy and the need for space. So look, we think it's part of a diversified portfolio. That's the way we look at it. It's capable of producing competitive, risk-adjusted returns if the conditions are right. And for us, the conditions at the moment is, again, vacancy rates in many areas of the commercial real estate are not high. We're seeing exceptional rent growth. I mean, I mentioned earlier about residential. US residential rents at the moment are growing at over 10%. Now, interestingly, that's actually feeding into the higher CPI numbers. And this is something we identified probably 6 or 9 months ago, that we were starting to see rents pick up and people were underestimating the inflation story because the US CPI, a big component relates to residential rents. And so what we're still seeing is residential rents continuing on at a very strong pace, and we think that's going to continue into 2023. So sort of moving off your question perhaps directly, but it is an interesting dynamic. What we're seeing in real estate is so important to the economy.
So let's move to your investment process and the fundamentals there. How do you go about filtering your REITs and your property assets?
So again, what we look for is cash flow. Right? Our fundamental belief is the vehicles that produce the most amount of cash flow for the least amount of risk are going to produce the best returns. So what we're trying to identify, again, hate to sound like a broken record, but it's part of the simple approach. We look for areas where supply is limited and tenant demand is robust. That way you have the best potential for cash flow growth. We look at balance sheets because at the end of the day, the one thing I have learned over 30 plus years in real estate is excessive leverage will always catch up on you. And so we've tended to find low leverage not only generates better risk-adjusted returns, but better absolute returns because those with robust balance sheets are able to take advantage of distress. So when there is distress, they're not forced to sell assets at the wrong time or raise equity at deeply discounted prices. They're actually able to go out and buy the distressed opportunities that are out there. So strong balance sheets for us leads to better investment outcomes. So we look at great real estate, great locations, pricing power, balance sheets, and last but not least, we look for management alignment and capability. At the end of the day, we are outsourcing the asset management, capital management to third parties, being property management, to REIT management, who frankly, we hope make us look smart. And it's amazing the good guys, the good operators, the best of breed operators in real estate, how much more they're able to extract from the land that the market doesn't appreciate, and how they're better able to manage the portfolio through the cycle, taking advantage of these opportunities that I mentioned before, and selling at the right time and recycling capital. So that's the basis of our approach to the investment in the area. We think it's pretty simple, straightforward. We only have about 45 stocks in the portfolio, so it really is trying to identify best of breed quality opportunities globally.
Point us to a couple of those REITs that do make your funds look good.
Look, at the moment, our biggest position is a stock called Prologis. It's one of the largest, if not the largest, logistics platforms in the world. Obviously, in the local market, everybody knows Goodman Group well, and we think it's a fantastic platform. Please, no question about it. But of course, in a limited pool of opportunity, Goodman stands out, and so everybody's piled into Goodman the last 5 years. For us, the cash flows, they derive a huge amount of cash flow in terms of reported earnings from performance fees and development. And the market is putting, we think, an excessive multiple on those relative to Prologis. Prologis does, in fact, do those other activities, but it does not include, promotes performance fees and development profits in its earnings. And when you strip those things out and look at the core of the businesses, we think Prologis is outstanding value. It's generating rent growth at the moment of high single-digit levels, net rental growth. It's undertaking development that is generating 50+% margins. It's earning fee promotes, which aren't included in the earnings. And so it's really delivering on all cylinders at the moment. So that's one example. Another big position we've got is in Invitation Homes. Invitation Homes owns about 80,000 freestanding single-family homes in the US, predominantly in the Sun Belt, about 70-75% in the Sun Belt. And again, rents are growing at over 10%. In fact, I think they'll come out the next quarterly, probably around about 12 to 15% rent growth, which is going to translate into earnings growth of about 15 to 20%. And we think that that's going to continue on into 2023. So, simple business, renting in a market which has seen an undersupply. Interestingly, out of the GFC, when there was too much supply, of course, the compensating effect is too little supply in the subsequent decade, leading to a shortage. We've now seen a migration to the Sun Belt, away from the coastal markets. We're seeing rising construction costs. We've got a great balance sheet in the form of Invitation Homes. And so there's just two simple examples that are, benefiting from the changing nature of the economy to e-commerce and the migration shift to jobs markets, better climates, and more affordable places to live. Elsewhere, we've got investments in life science, stock called Alexandria, which is benefiting from obviously all the extra research that's now being done into virus research and a range of other diseases, etc. And this is a stock that really is the industry leader and has an amazing footprint in some of the great, near some of the great university and colleges around the US. For example, in Boston, in Northern California, Southern California, and the quality of its cash flow is exceptional because people think it's research, it must be high risk, but they don't recognise that these research programs are multi-year, if not multi-decade. So these businesses, when they undertake that research, they're well funded to be able to execute the research over a long period of time. So they've been great performers during recessions because the research into developing new drugs doesn't stop. It carries through. So look, there's a couple of examples there of real estate that is relevant to today's economy and beyond.
Now, Andrew, ResCap's well known on the institutional side, but you've just listed Australia's only actively managed global REIT ETF on the ASX, ticker code RCAP, and it's essentially a listed version of your flagship Global Property Securities Fund. Why are you releasing this fund to retail investors?
Well, we think we always have, but what we're trying to do is to make it easier and to make it more accessible to a broader number of investors. And the way I think about it is we've been selling through JB Hi-Fi, who's obviously a great way to sell your strategy, but we're now going to sell through Amazon, right, as well. So it's really just trying to cater to the varying needs and wants of a broad range of investors to make life as easy as possible. I mean, we all know how challenging it is filling out forms for new applications, for new funds, for withdrawals, etc. So the ease of just ringing your broker and putting on a buy or a sell order and executing it that simply, I think that's of enormous appeal to a broader range of people. So for us, It's nothing new, it's literally just improving the accessibility to more investors and to hopefully make life easier for people.